SoFi Technologies, trading under ticker symbol SOFI on the NASDAQ, sits at $6.84 per share, up 1.94% during today's session as buying pressure builds through midday trading. Volume is pacing near 38 million shares, showing steady institutional participation as regional banking concerns cool and tech-heavy financial platforms catch a bid across major trading platforms. Most retail investors looking at SoFi Invest right now see a fintech company finally clawing its way back toward profitability after years of burning cash to acquire users. The common consensus across retail forums and self-investing communities is that SoFi is essentially a glorified bank with a slick mobile interface, bound to struggle under high interest rates and student loan uncertainty. But that mainstream narrative misses what is actually happening underneath the hood. While the market treats this like a standard consumer lending outfit exposed to macro turbulence, institutional order flow and underlying segment margins reveal a clear divergence between surface-level stock price movement and the platform's core financial mechanics. Looking at the immediate price action over recent sessions, SoFi stock has been coiling in a tightening range, bouncing off technical support near $6.20 while testing resistance around the $7.10 mark. Short interest remains elevated above 15% of the float, creating a persistent layer of tension every time the broader market rallies. Institutional activity has quietly shifted. While retail traders cycle through trending stocks on Robinhood or check daily quotes on the Robinhood app, hedge funds and systematic managers have been accumulating SoFi shares during dips. The recent earnings reaction provided a prime example of this dynamic. The company posted record net revenue and non-GAAP profits, yet the stock briefly sold off on conservative forward guidance before institutional buyers stepped in to absorb the selling. The pressure from macroeconomic factors cannot be ignored. High interest rates generally benefit traditional lenders by widening net interest margins, but for online investing platforms and digital banks, higher rates increase the cost of funds and slow down loan origination volumes. SoFi managed to counter this trend by growing its total deposit base significantly, reducing its reliance on expensive warehouse financing facilities. This deposit growth gives the company a structural cost of funds advantage over pure-play online brokers and smaller fintech startups that lack a formal banking charter. When comparing the capital efficiency of SoFi Active Investing to standard individual brokerage setups or legacy investing sites, the ability to fund loans with low-cost consumer deposits changes the unit economics entirely. To understand why this expectation gap exists, it helps to step back and examine how SoFi actually operates as a business model. The company started primarily as a student loan refinancing outfit, catering to high-earning, credit-worthy young professionals. Over the past 5 years, leadership systematically transformed the enterprise into a comprehensive financial services supermarket. Today, SoFi operates across 3 main segments: lending, financial services, and the technology platform. The lending arm generates revenue through origination fees and net interest income on personal, student, and home loans. Financial services encompasses SoFi checking, savings, credit cards, and SoFi stocks trading within the SoFi mobile app. The technology platform segment, powered by Galileo and Technisys, acts as the infrastructure backbone, processing transactions and providing core banking software for other financial institutions globally. In past performance cycles, investors treated SoFi purely as a lending stock, pricing it in lockstep with traditional regional lenders or subprime credit platforms. But as the financial services and tech platforms scale, fee-based, high-margin revenue is replacing risk-weighted lending revenue. That shift is central to evaluating SoFi ETFs holdings, individual stock portfolio allocations, or general investment strategy. While legacy brokerages like Schwab Intelligent Portfolios or traditional Fidelity mutual funds emphasize long-term capital preservation through diversified indexes, high-growth fintech platforms rely on expanding member lifetime value while lowering customer acquisition costs.
SoFi has successfully cross-sold multiple products to single users, turning basic checking account holders into active traders, mortgage applicants, and credit card users. Comment below how many shares of SoFi stock you currently hold, or if you are choosing to invest online through alternative platforms instead. Looking ahead, the market faces several potential catalysts and structural risks over the next 12 to 18 months. The primary catalyst is the continued acceleration of non-lending revenue. If Galileo and Technisys secure additional enterprise-level banking clients, SoFi's margin profile will shift closer to a pure software-as-a-service company than a traditional bank, commanding higher valuation multiples. Conversely, the core risk remains credit performance. If economic conditions soften and defaults rise across personal loans, SoFi will be forced to increase provision for credit losses, directly impacting net income. Additionally, competition in digital wealth management remains fierce. Major players like Fidelity Investments offer Fidelity brokerage accounts, Fidelity ETFs, Fidelity IRAs, and advanced tools on the Fidelity mobile app or Fidelity trading platform, making it tough for newer platforms to capture older high-net-worth investors. Similarly, Interactive Brokers continues to dominate sophisticated active traders with lower Interactive Brokers fees and global market access through the Interactive Brokers platform. For SoFi to outperform market expectations, it does not need to displace titans like Fidelity Wealth Management or Interactive Brokers stock trading overnight. It simply needs to execute on its guidance, maintain deposit momentum, and demonstrate that its financial technology stack can generate high-margin recurring revenue independent of interest rate cycles. The tension between the market's perception of SoFi as a vulnerable online lender and the reality of its diversified digital banking ecosystem is where the ultimate valuation discrepancy lies. Investors who look past short-term daily volatility and evaluate the platform's long-term unit economics will see a firm steadily executing its strategic roadmap while mainstream sentiment catches up.